Hello everyone, Steve Lentz here. This is our Monday Mentor Series, and welcome. It is May 6th, 2013. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance, and we put that in there because today we will be doing a bit of a back-testing work on the credit spread system using the DMI Stochastics indicator. When we were together, about 3 weeks ago, 4 weeks ago or something, we went over part one, which was simply explaining the indicator. What we're going to do today is review that, and I'm going to pretty much just keep to the same slides, only I'm going to kind of race through it a little bit. And I think in the email that went out from Jim, you got a link to part one. Well, that was a bit more of a prolonged description of the indicator. Today I'm going to do the same thing. We'll just go a bit quicker through that so that we have more time for the actual credit spread portion here, okay? A little bit about our company for those of you new. Discover Options is the educational arm of OptionVue Systems International. OptionVue has been in business since 1983, primarily focused on high-end options analytics software. Now, Discover Options is the mentoring educational arm, and we focus pretty much exclusively on one-on-one mentoring. So we have a team of mentors, Steve Papali, Ken Dole, Frank Fahey, myself, and we're teaching the same strategies in the non-directional category. Today is a directional system, all right, but the money management going on amongst our mentors, because they mentor on the side, they're primarily managing money. We're using the non-directional stuff, credit, primarily butterflies and condors. And that's because the investors that they have, want to take part in the non-directional stuff, and so they have a real, couple real good programs, and we teach you that in level 3 of what we do. Now, what you're going to hear today is kind of a repeat of what I did for our mentoring students in a presentation I do on Wednesdays for our mentoring students called Inside Wire. And every Wednesday I get together with those that can attend, and it's live. I present a PowerPoint, a trading idea, and we kick it around a little bit. And I do that every week. Every month I go over how well our non-directional items did, and that's going to happen this Wednesday for our mentoring students. But the other 3 weeks during the month, I'll approach a different trading idea, and this DMI Stochastics was presented in the Technical Analysis of Stocks and Commodities magazine, Stocks and Commodities magazine, just for short, S&C for really short. And I saw that. I said, okay, let's put together a credit spread system here. So that was just, that took up maybe 2 parts, 2 weeks. And we just, as I see blog entries on different ideas, I'll test them out and present it. If I go to a trade show and some of the folks that come to the booth present, tell me about what they're doing, I'll kind of make that a trade show strategy. We talk about hedged credit spreads was one of them. It's kind of interesting. But all those are archived. So here we go on this one. DMI Stochastics Part 2. Here we go. S&C magazine. Here you can see the article, DMI Stochastic. Barbara Starr writes some great articles there, some real good ideas coming from her over the many articles that she's written. And so we're going to take the indicator that she presented, and we're going to adapt it to a credit spread system. Now, when you go into S&C magazine, you will get some portions that, in this case, they give you the Metastock code. This indicator is not really automatically built into Metastock or into OptionVue. Metastock has a code, a language that you can program your own indicators, and in that magazine, January 2013 was the article, and then as well as the Metastock code. Now, if you want to go down this path and use this, I would suggest you get a trial of Metastock. Okay, you get a trial there, let's see. And you could get one by simply going to, I think it's just simply metastock.com/OptionVue. Real simple. And then they also include the coding for other charting programs. I think Thinkorswim might be in there. I'm pretty sure Amy Broker might be in. You know, a whole bunch of other programs. They have the coding for them. But here's the Metastock code that you can use. But I would, you know, if you want this, you could go to metastock.com/OptionVue and get a trial. All right, so in the world of technical analysis, generally, you're using statistical extractions from price to determine trend, you know, up or down, to determine more short-term pullbacks. Also, you could use technical analysis to determine a trigger and then a stop. Now, we're going to pretty much focus in on the first two because the second two, you know, don't really require a whole lot of analysis. It's pretty much is simple entry rules that we'll get to later. So we're interested most in using technical analysis to get our trend condition and our pullbacks. So right now we're going to go over what is the DMI. We're going to then create the DMI oscillator, and that's going to help us determine trend. Then we're going to put that on the shelf because now we have to figure out a way to determine pullbacks, and that's through the use of stochastics. Okay, and so after we get those two figured out, we're going to then go into a system of actual signals generated from this very interesting indicator. By the way, I was really, you know, encouraged to pursue this from one of our students who trades credit spreads on using the DMI Stochastic. Okay, and I saw it in the article. I had, you know, conferred with him on emails and stuff, and so this is coming from me, but also, you know, give credit where credit is due. One of our students really is a huge fan of this. Okay, first, what is the DMI? Directional movement indicator was developed by Wells Wilder. Stuart, is it on weekly options? No, Stuart, we are focusing in on the monthly options. You certainly could use it on weeklies, I suppose. I'm just looking at the questions as they're asked. I'll do my best to keep my eye open over there. DMI, developed by Wells Wilder. By the way, this book is amazing. This book, if you're into technical analysis and you want to get some of the original good stuff, this book, New Concepts in Technical Trading Systems, was published in the 70s, I'd say. And in one book, you get the whole ADX DMI system, RSI. He came up with average true range and a host of other tools, all without the use of computers. He was using spreadsheets instead. And just a fantastic book. Now, you know, you can certainly go online and get descriptions of all the things that he brought up, items he brought up in the book. But if you're into that stuff, I would suggest getting a copy of this book just for your library. It's very interesting. The DMI, when you post it on your chart, is usually in the context of something called the ADX. The ADX, and it results in having three lines down here in a lower chart underneath your price. A green line, red line, and black line. The black line is usually the ADX line. And we are not going to include the ADX in our analysis here. Now, that's one of my systems I got on the back burner. You know, the more I read about ADX, and I know many of you, if you're watching this, may have been attracted to DMI, you know, ADX, and you might be ADX aficionados, right? Well, sorry about that. That's going to be for later. I'm working on one. I know the ADX is a powerful tool, and we'll look at this, you know, maybe sometime later. Stuart, are the moves of price not too short for monthly expirations? No, well, you'll see, Stuart. We're going to show you the the back-tested results, and you can judge for yourself. Okay. I mean, plus you got to figure out where you're going to stick the credit spread, and we'll get to that in just a second on the rules there. What you end up with are two lines now, green and red. Green and red. Now, here's the premise behind DMI. All right. Usually you'll have a moving average. If you're into technical analysis, we use a lot of moving averages in a lot of what we do. We're not going to do that here. Instead, we're focused in on the actual price. Now we're working on DMI now. Now here's the concept behind DMI. It's the largest part of the current trading range that is outside the previous trading range. Okay? So let's just take a look at this. You can kind of see here, all right, look at the area in green is outside the previous day. Okay, before it's outside the previous. Now on this bar here, there's a little part down here that's outside there, but that's the smallest part. The green is the largest part. And you only focus on the largest part that lies outside the previous trading range. So let's just go through this. Here you can see that largest part is the 5 point. You got the 1 point down here. So then what you do is, let me get a line here. We're going to put the 5 over here. That becomes the positive directional movement. Change colors. That becomes the positive directional movement. Okay. The 1 does not become the negative. Instead, we make it a 0. And so you can either have the highest number or 0 for that day. So this day's directional movement is 5. Period. There is no negative directional movement. You only label the movement that had the highest for that day. Jim, I just said I'm going to review part 1 and then get to the credit spread, okay? I know you're saying, hey, this is part 1 stuff. When will you start on the new content? I'm going to go through this pretty quick. Sorry about that, but there are some new folks here, and I want to just make sure we catch everyone up. All right, here you have the 6. Okay, that goes to day 2. And for every day, you just simply throw in the progression there, so that you have a list of positive directional movement days, a list of negative directional movement days. A lot of days have zeros, of course, because it went the other way. So then you array these lines here, and what you have to do is normalize these for true range. For true range. You can't just say, oh, here's the 5, here's the 6, here's the 4. You have to normalize it for what we call average true range. Okay, and this is another concept by Wells-Wilder, which is true range, meaning something other than just, we take the high and the low, and that's the day's range, that's the true range. No, it's the largest of any of these 3 items here. You can't just say, today's range is high minus low. Okay, now that for that first day, indeed it is high minus low. That is the largest of those 3 definitions. Now, the next bar falls under the category of the third one, yesterday's close minus today's low. There to there. That results in the highest. And that's because we are now accounting for what we can have as gaps. When you have gaps, okay, if you have a big gap and then a tight range, well, what's the real range? You have to factor in the gap. And so by including these other definitions, we now have a better handle on the actual range. So here's the definition. That green line, let me choose the green. The green line, oops, timeout. The green line is going to result when you take in this case, the 14-day weighted moving average of those positive directional movement. You're going to divide it by the true range. That gives you the green. And then the red line is when you take the negative directional movement. 14-day weighted moving average divided by the true range. Okay? And that gives you the red line. And so you can see here here we go. Look at this up in price. When you have whole big areas that lie outside the previous day's range, okay? All right, that's going to result in the red line going up when you have it on the downside. Now watch this. When you have whole days where the range lies hugely outside on the upside the previous day's range. Look at that. The big portions are lying outside the previous day's range to the upside. Well, now the green line is going to start coming up. So you can see in down moves, you generally have the red line above the green. Generally in up moves, in an uptrend, the green line is above the red. Typically, signals occur when the lines cross like this. when the lines are crossing. All right? Now, what we're going to do now, in going towards our indicator, we've got to take these two lines and create an oscillator. And this is the advancement. We're going to push the envelope a little further. We're going to create an oscillator, and it basically is the difference between the green line minus the red line. The green line minus the red gives us a positive value. When the red line is above the green, it's going to be a negative value. And what we're going to do is chart that difference in an oscillator like what you see right here in the red. So when the green line is above the red, we have positive values. Okay? Over on the left, when the red line is above the green, we have negative values, just like that. And this oscillator is what we're going to use as our main focal point, and we're going to actually apply stochastics to it and not to price. So let's put this on the shelf. We're going to now go look at, oh, not yet. Here's what I did is we paint the bars blue when we have positive, paint the bars red when we have negative. Okay, just like that. All right, now, putting that on the shelf, okay? Putting it on the shelf, stochastics. Real simple. Stochastics is a way, it's a statistical extraction of price usually, but we're going to compare the closing or current price, okay, of an asset to its price range over a given time span. Now, what does that mean? Okay, well, I'll show you in a second, but the advantages of stochastics, this is a very flexible indicator. Boy, you can use it for trend, for divergence, for pullbacks. You know, George Lane, the inventor of this, used it for everything. Okay, he didn't use any other indicators except derivations of stochastics. Here's the actual formula. It's pretty simple. We're going to take the current closing price in relation to the high and the low and scale it so that it lies between 0 and 100. Such that right here, let's take this. You have a 14-day look back. Okay, look over here. You have the current closing price. Where is that closing price in relation to its 14-day range? Okay, is it pretty high, pretty low? It looks kind of low on the low end. So indeed, you take the three values, the closing price, the low, the high, okay, and you run it through this formula here. And where do you think %K is going to be? %K is what we have down here, all right, and %K is, boom, 1.5. So on a scale of 0 to 100, today's price on a scale of 0 to 100 over 14 days is at a 1.5, very, very low. Let's take another example. 14 days, current price, is it relatively high or low on a scale of 0 to 100? Scale of 0 to 100, are we up closer to 100 or down closer to 0? Okay. Yeah, TJ, this is the fast stochastic. We're going to get to the slow in just a second. This is absolutely the fast way to do it. But great question. Great question. So let's run these numbers. Here's the close right here. On a scale of 0 to 100, that's probably pretty high. So we run those numbers. We have the close, we have the high, we have the low. We run it through this, and we get a value of 94.29. Way up there. See that? Okay, so that's pretty high. And what it'll do is, you know, when price starts chopping around, well, it'll be kind of in the middle here. But when it gets to an extreme over its range, well, then you get up really over 90, down below 10, and those are overbought, oversold situations. Bob, yes, it's being recorded. Thanks for joining. I know you have to leave, but that's fine. It is being recorded. Okay, so here's the fast stochastic. TJ asked about fast. Fast means that %K, which is basically the actual number we've been calculating here, as I've shown you, it's kind of going to be choppy quite a bit. You can kind of see these hard edges to it. And what we're going to do is take a moving average of this and slow it down. A 3-day moving average slows it down. Do you see how it becomes kind of more gentle? The hard edges have been taken away a little bit. That's called slowing it by a value of 3. 14-3 would be the setting. And this becomes the new %K. It's slowed. We slowed it by taking a 3-day moving average, simple moving average, of the fast. Still, we call it %K. Now what we do to get signals is we apply a moving average to this slowed, in this case, a 3-day moving average. Boom. And you now have your stochastics indicator. And you have this is a slowed 14-day %K. We're using a 3-day average for our trigger line, which is also called %D. And the trigger points for signals occur when you have crossovers right there, when it crosses over its signal line. And, you know, it kind of works out pretty good sometimes. And in a choppy market, a non-trending market, this can be a very valuable indicator to use. All right. Here in OptionVue, you have a default setting of 1433 on a lot of programs, including OptionVue. Stewart says slow means simple versus exponential. No. No, slow means we're going to take a moving average of, we're going to always take a simple moving average of this fast %K. Okay? So %K is always fast unless you deliberately slow it. Okay? And so let me show you the nomenclature. Typically in the world of, well, let me go here. Oops, time out. Boom, boom. Okay? Boom, boom. All right. Here's the nomenclature. You have %K's time periods. You know, what's our look back? All right? Usually the default is 14. Then you have whether you're going to slow it or not. This is a simple moving average of this fast %K. If you want to keep the fast, just make that a 1. Okay? If you want to make it fast, just keep that at a 1. It's a 1-day moving average of %K. Then you have to have your trigger line. And this is %D is your trigger line. And that's what that is, 1433. So when you see 1433, that's what you got. If you see, now let me show you this one. Look at this, 1512.5. Okay, 1512.5 means a 15-day look back, slowed a lot by taking a 12-day moving average of that, and then we have a 5-day moving average for our trigger line right here. And this is more of a trend confirmation approach using stochastics. And you can kind of see going down, we have a nice gentle signal right there. And then when it crosses, several weeks while it's going up like that. So this is, you can make stochastics actually show you the long-term trend like that. And that's a 1512.5 in that particular case. There you go. All right, now, let's take the DMI oscillator off the shelf, put it up there on the top. Then we're going to take the stochastic concept, and we're going to use a 10-3 setting, no %D. In this case, no trigger line. No trigger line. We're just going to do a 10-day look back, smooth it 3 periods. Okay, to get our stochastic, our DMI stochastic. This is the stochastic of the DMI oscillator up here. So here you have the oscillator. Oops. Golly, here you got the oscillator. I'm highlighting it. And we're going to take the the stochastic of that. So watch this. When you have the stochastic oscillator making new highs, okay, you can see the stochastic goes up there. The DMI oscillator is making new highs here, and this thing is up near 100%, 100 on a scale of 0 to 100. It's pushing 100 when it's, getting right up there like that, right? All right, you can see where we're going with this. We're looking for kind of, kind of an overbought, oversold situation, but we're doing it using another indicator besides price to do it. So watch this. Look at this. Here's how we're going to map this out. Price is highlighted in blue when we're in the up periods there. Boy, that's a mess. Cheapers. Holy cow. All right. I hope I haven't. Let me go to the questions here. Nope. Okay, good. So we're taking the oscillator when it's positive. We have the blue. We have the blue when we're positive, etc. Okay. When the oscillator, okay, is getting really at its all-time highs for the last 10 days, that's when the stochastic is going to really show us that we're kind of in overbought territory at that point. You see that? Now, so instead of applying stochastic to price, we're applying it to the oscillator itself. Okay, so let's back up. I just thought of this. Let's back up and review just to make sure our mindset is there, because a few questions revealed to me that maybe we're not quite there yet. When the oscillator is getting at its all-time highs or lows, what does that mean? Okay, what does that mean? Well, just indulge me for a bit. I'm going to go back, and I know we're just reviewing, but I want to make sure what we're doing there. The oscillator, when it gets really high at its all-time highs, that means that the green line is really far from the red. And the width there, it could be at its all-time high for the last 10 days. When you have the oscillator at its all-time low for the last 10 days, getting really low, and that oscillator and that stochastic is going to go down to under 10, that's when the green is way under the red, and the red is way above the green like that. That's what that's showing us. So we're looking for those periods of extreme difference here, hoping that we're going to find out when the market is overbought and oversold. And we're going to tee off on that using a credit spread system. All right, so let's go back down. Doom, 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 doom. Okay, sorry about that. All right, so signals off the extremes. All right. So when we have blue bars, that's telling us the trend is up. We are positive here. We're looking for those times when the stochastic, the DMI stochastic, drops down, telling us that amidst this uptrend, we have a pullback into oversold territory. And at that point, we're going to put on a credit spread. Okay? Likewise, shoot, there we go. When we have a downtrend and the bars are red, we're now going to trade this where there's big enough pullbacks that let's see, we don't have a whole bunch here. Okay, here, pulled back. There's a pullback to the upside such that it is now overbought, and we're going to now continue with the trend to the downside at that point, and that's the idea. So let's go back up to the rules. The DMI stochastic goes below 10 and bounces up. We're going to take the signal only if the price bar is blue, just like I explained. When the price bar is red, we wait for the stochastic to go above 90 and then curl over. Okay, to go above 90 and curl over like there. There was a good signal there. But this keeps us, we just don't want to take these oscillator signals, right? We got to pay attention to the direction of trend. Look at all these. We had sell signals all the way up as the trend was up here. Well, we don't want to take short signals there. We only want to take short signals where the trend is down. Okay, so that's, again, the story of technical analysis. Determine the trend, determine the pullback. Lots of different combinations. This is just one of them. Okay, so here are all the signals filtered. Okay, all the signals. And what we're going to do is test all of these. We're going to do credit spreads on all of these. And we could have as many as, I think at one point in the last couple of years that I back tested this, we had about 3 credit spreads on at once at one point. Okay, signals from other extremes. We don't need to look at this. You could look at the crossovers here. We're not going to look at these. You know, you could use those instead. Okay, here are the trading rules. Let me get a sip of rapidly cooling coffee. I should have been drinking this earlier. I got up this morning and we didn't have our normal coffee going, and we had this alternative stuff. And I don't know, on a Monday morning, of all times, you want on a Monday morning to have your normal coffee, and somehow it got messed up. I had 2 choices, and I didn't like either one of them. So I had to wait till I got in the office here. Just a second. All right, here we go. We're going to take every extreme signal, bearish and bullish. We're only going to look at the close. So near the close is when you put this on. We're going to place an out-of-the-money credit spread, and we're going to do it like this. We're going to put it so that the short strike is set closest to the value of 25. Okay, so if you have one option at 28, another one at 23. 23 is only 2 points away. 28 is 3. You take the one at 23. Okay, so we're just going with the option that is closest to 25. We're going to, of course, go to the first month with over 21 days remaining. Now, someone asked about, hey, should we use weeklies on this? You know what? I think you could maybe look at using weeklies. But, you know, and here's what we do at Discover Options is we like to test all this. And in OptionVue, you get the ability to go through and paper trade at warp speed any strategy you have. Now, for me to back test this took a few hours. But, you know, the benefits of taking, you know, 2 to 4 hours to back test this. Now, I've been doing back testing a lot. I'm able to quickly go through it. But once you get used to it, you could really go through and back test a year of a strategy like this, lickety-split, and it helps to keep your rules simple, of course. And I'll get to that in just a second. We're going to test this using the SPX 20-point spreads. And here's our exits. Exit at expiration with our full profit, or, okay, and then when bad things happen, when the SPX reverses and goes the other way and hits your short strike, then get out. There is no yield grab. In other words, if it goes your way in a week and you have most of your credit sitting there ready to take as a profit, our benchmark rules here state that we're just going to stay in the trade no matter what and not get out. In real life, if you had 95% of your available profit sitting there, would you take it? Well, certainly. We're doing this just to see the viability of the system and just to get a benchmark set of returns to see if it's something worth pursuing more. If you decide this is something you like, you'll need to get access to the DMI Stochastic. And then I would suggest you get, if you don't already have OptionVue's BackTrader, get OptionVue's BackTrader system that enables you to quickly piece together whether some alternatives to these exits. One alternative is I'm just going to put YG, yield grab. Okay, and you could make up your yield grab rules and test it out. It'll take you a lot longer to test yield grab rules than just going at expiration. But certainly, if you have 2/3 of your available credit, ready to go as profit, you should probably close it out and take that money and apply it to another opportunity. Okay, that's what we found, and that is what we teach at Discover Options. But in terms of testing, we do like to keep things at expiration just to get a good feel if something has viability or not, okay? Let's see, Al, you know, I don't know that the recordings are available on a website. Jim is listening, and maybe he could give me some input before I answer. But I know it's being recorded, and I know the previous link went out. And I'll wait for Jim to answer that to me. But I'm not sure that we we haven't made these available, you know, in an archive fashion. Okay, let's see here. Boom. Here are all the signals going back to 2011. What I did is I went through and took all the signals, even if they overlapped, January of 11 onward, and you can kind of see. And what I did is I'm showing you the oscillator. Okay, here's the DMI Stochastic down here, and when those rules were met, okay, you can see I used Metastock's expert system to paste an arrow right there. And if you were to zoom in, you can kind of see how these arrows all occurred after a pullback and then a continuance in the direction of the trend. Let's take one example, and then we'll show you the summary results. Let's go back to February of this year, and you could see this particular bar. And what happened there is the oscillator came down. Okay, this thing, the blue line came down. Now I'm not trading the crossover, although that may have happened, but the blue line came down past 10 and then popped up over 10. And that's what we're doing. Okay, let me go back to the rules. Okay, we're doing the extreme signals. Let's go. Let me show you those extreme signals. Okay. Let's see. Where are the extreme signals? All right. Here's the long ones. If the stochastic goes below 10 and bounces up over 10, then you take that signal, assuming you have a blue bar. All right. If you have a blue bar, that's what you take. So let's go back down here. Let's take a look. It dropped below 10 and then went over 10. With that, after this pullback, it popped over 10, and away you go. You put on a credit spread at that point. Well, Steve, look what happened. It came down here. Here's the beauty of a credit spread. The credit spread was placed at a strike out of the money down here, and our rules were such that even with this bad behavior, as long as the trend eventually kicked in again, we ended up making money on this. So let's see what strike we sold. Remember, the market here came down to about 1486. 1486 or so. Now, if we sold premium underneath that, well, then remember, we were challenging the market to go all the way to our short strike. So here's the deal. When that signal occurred, we came out of the money in the puts. Here's the current price. We came out of the money in the puts, and we're selling premium, and I think we went to the 1480 here. That's the strike that was closest to having a delta of 25. And we're saying, Mr. Market, you're showing a good trend. You've had a pullback. You're now busting out again. We're going to challenge you to reverse course and go all the way and touch 1480. Now here it didn't. It fell short by 6 points, and it kept, and then resumed its upward trend, which is great. This trade ended up making money even with that little scare that occurred, right? And that's the beauty of credit spreads. You have a lot more room for error like that. So let's go and take a look at the matrix, what it looked like, and here's what it was at the time, the close on February 8th. The strike closest to a delta of 25. Okay, this one was 2.8 away from 25. This one was 2.1 away from 25, and this is the one we went with. Had we chosen the 1490, we would have been stopped out. In this case, we went to the one down below, and it worked out that, you know, this one, in this particular case, it worked. Roger is saying, why 25? Why 25? Well, Roger, earlier in our system development, and we still look at these, we would take a standard deviation. A standard deviation. And when I was putting this together, well, let me say, I'll say it like this. You know, and I'm gonna cite one particular student in particular who came to me and said, Steve, you know, I love these credit spread systems based on technical analysis. The trend approach, this is a trend following one. I've developed many counter trend ones as well. And this particular student said, you know, I've been just teeing off, kind of picking up where you left off, and have continued. And he found that instead of a standard deviation, he would use a delta number on the option that he sold. And he told me he felt that the 25 number was a sweet spot, so to speak, in terms of some of these strategies. Because if you go a full standard deviation out on some of the strategies, you're just not going to get a whole lot of premium, depending on the volatility considerations. You're just not going to get a whole lot. You get a bit more premium when you're making it a delta of 25. You're typically quite often inside a standard deviation, getting a little bit more premium, yet when you lose, you're not losing so many times more than the premium you're trying to get. So on this particular system, I departed from my standard deviation benchmark and went with a delta benchmark just to see how it went. Now, those of you credit spread experts, you have your own approach. And you know what we're talking about when we say the standard dev approach versus the delta approach like this. This is clearly a delta approach. I'm using 25 based upon the testing of another student we have. And I don't know, let me show you the results here, okay? Let's see. Stuart says it means 85% will not be in the money. It means 85% at expiration will not be. I don't know quite what Stuart's saying there. The delta sometimes is referenced as the probability of finishing in the money. And that's just simply not true. Okay? You know, some people say, hey, you know, here you have an at-the-money option. Here's an at-the-money call. Delta of almost 50, roughly 50, right? Here's one at 52. And an at-the-money option, typically, now that's, well, this is slightly out of the money actually, so it's a little bit lower, okay? But anyway, in general, an at-the-money option has a delta of 50, and in general, of course, an at-the-money option has a 50% chance of finishing in the money, right? Well, does that mean the further out you go and the deltas change, that these probabilities, when you play out the probabilities, they begin to depart? Okay, delta references how much an option's price changes relative to a move in the underlying. It is not a probability measure, and some folks have tried to equate the two, and you can't. It might be close. Certain options, in certain volatility considerations, it might be coincidentally close. I would just simply caution you against equating delta with the probability of finishing in the money. Let me give you one little clue here too. In OptionVue, our delta numbers are more accurate than what you're going to see in Thinkorswim or any of these other platforms that don't use really a variable model with the accuracy that we have in OptionVue. Now let me show you what I'm talking about. You could see here that this at-the-money put, just as an example, is an implied volatility of 12.6. As you go further out of the money in the puts, you could see that the implied volatilities rise. Such that here's this, if this option here with an IV of 14, if this option becomes an at-the-money option, okay? If the market goes down and this option drifts further up and becomes an at-the-money option, its implied volatility is going to drop, right? And that effect, that vertical skew, has to be included in your delta calculations if you want delta values that are truly real world. Okay, and in OptionVue, we treat delta in a real world context. We want our deltas to tell us realistically how much that option is going to change value, and we're going to throw in everything into that number, including the kitchen sink, the vertical skew, how much the market all in all goes up and down. Will the VIX, you know how the VIX goes up when the market goes down? We call that CEV, constant elasticity of volatility. We throw that in the mix. So our delta numbers, we call them true delta because we feel that the academic deltas, with all the at-the-money options are at 50, you know, those academic deltas are not true. They're academic. They're not real life. And so, you know, again, it's all started about using probabilities and deltas in the same sentence. No, please don't do that, okay? They're not the same. Okay, where were we? We were talking about this. We're selling this one here. We're doing a 20-point spread in the credit spread. Boom. I'm throwing in commissions, a pretty healthy set of commissions here. Now, in my testing, admittedly, I used the midpoint between bid and ask. I didn't adjust for slippage coming off of that midpoint. So in the SPX, if you put in a market order, you're going to get creamed. Never use market orders in the SPX. Always use limit orders and start out trying to get that midpoint between bid and ask. You're going to have to cave a little bit in some conditions, but this is if not the most liquid market in the world, one of the top 2 or 3 liquid option markets in the world. Yet, because of the monopolistic nature of the CBOE having this SPX trading pit, the published prices between the bid and the ask are going to be very wide. So the published values between bid and ask are wide. Realistically, there's a very, very tight market going on there, and you have to access that market through the use of limit orders. Okay? But I used a pretty fat commission here. So when you see the testing results, just understand, didn't adjust for slippage, but I did give some pretty fat commissions there. 20 points, Stuart. We're going 1480, buying the 1460s. And we're always using the first month with over 21 days. Delta closest to 25. In this case, it worked out. We could see the market came down, got close to our 1480 strike, then went up again. And it expired worthless. So that trade worked out. We banked the whole profit of $328 on this one lot credit spread. Okie dokie. Now, and here's the graphical representation in OptionVue. You can kind of just see here, you know, we're just inside, well, right about at that standard deviation or so. Okay, where we sold that option in that particular case, it works out. It's usually a little bit inside one standard deviation. Just depends the vol number going into this thing. Here are the results. Let me get another sip of cold coffee, and away we go. Just a second. All right. 2011 up through the current April 19th. And you can see I looked at 35 different trades. I took all of them. At one point, I had 3 on at the same time. Each trade requires $2,000 minus the credit. That would have been $6,000 minus the combined credits, roughly $5,000 or so. And putting this on continually, 2/3 of them made money. The average winner was a little less than the average loser, but the winning percentage was high enough that it overcame that, and it ended up having a nice little, you know, an edge to it. Let's see, 23 winners, 12 losers. turned out to be half and half on the calls and puts. 6 were the call side, 6 were the put side. There was no consistency there. Okay, so half of them were the bearish trades lost, the other half were the bullish trades lost. I'm curious what would be the result on weekly bars with less trades. Now, Stuart, that's a great question. I mean, certainly you're going to have a lot fewer trades during the year, and you'd probably want to go farther out in time, I'd imagine. But certainly that would be something to look at. Let's see. I did do an annualized return. I started with 8,000, and that took care of the initial requirements plus the drawdown that occurred. So 8,000 could have been used to do a 1 lot, and it worked out all in all 22% annualized return. And you can kind of just look at the stats there. There are all the trades, and the tough part, here you have the drawdown occurring, kind of rough. But if you could have weathered that, then you were in for a nice little ride here. Now, clearly everyone's saying, hey, well, what filter can you use to get rid of those reds? Okay, I didn't look at any other filters. Certainly it's something to maybe think about doing, because that's how systems testers think. You could look at the market conditions from March 23rd of 11 through August of 11 to ascertain that, and maybe try and filter that out. But be careful, because in filtering those out, you're probably going to also filter out several of the winners down here. Let's see. With the 50-day trend of underlying. Yeah, Bill's suggesting that you apply a trend filter. Let's just for grins go in here. Oh, and by the way, here's the equity curve. You know, we made a little bit of money and then incurred this pretty tough drawdown, a couple $1,000. And then we would have had enough to still stay in and absorb 3 trades at once, and then off to the races we go. And it's done very, very well since. So let's go back and just for grins, let's see, yeah, that was my last slide. So let's go take a look at March 23rd of 11 through August. March 23rd through August. So did I have a slide here? March 23rd right here through August here. Yeah, right here. This was the time period where we lost a bit there, okay? And of course, look at that. I mean, you got whipped pretty good right there, and then we got chewed up here amidst this August. You remember August of 11? There were some wild swings, down, up, and then down in September. August of 11 was a rough ride, and you could certainly try and filter that out using something, but that filter would probably take out some of the winners that we had over here. Okay, so let's see, anything, yeah, Bill, so if SPX is trending up, you only take the put trades? Yeah, Bill, if the SPX is trending up, and we have blue bars going on because we have a positive value in the oscillator, we would only put on the put trades. When the market pulls back and goes back up again. See that? That's the idea. And yep, that's what we're talking about. Now look, you can certainly apply other filters, but you'll just simply remove a lot of profitable trades quite often. But you know what? This is just one way of trading credit spreads. It's teeing off on the notion of trading with the trend after a pullback. We're trading with 25-point deltas. Could it be improved on? Yeah, there were probably some trades here where a yield grab would have gotten us out early before it turned into a loss. Okay, I think that happened more than one time. On the other hand, if you're pulling a yield grab off, you're giving up a third of the profit, and you have all those, the 2/3 of the times you made money, you would have given up a third each time. So all things considered, you know, it's a pretty, I think you see that you have kind of the indicator itself in this approach shows you that you do have an edge, at least for the market that occurred over the last 2 years. This market condition where we had all those losers, choppy, then a big whipsaw down, and more choppy. Okay, and so maybe the ADX, there was an interesting suggestion from Stuart. Maybe apply the ADX filter, and that is certainly a filter that tells you if something's trending or not. And maybe having the ADX at something other than 14, I don't know, might be good. Why not roll from a loss? Why not roll from a loss? Well, if you're rolling from a loss, presumably the market has reversed course and gone far enough. Why not roll from a loss? Let me think about that. So if you're losing, yeah, I would say that if you sell an option out of the money at a delta of 25, the market reverses, comes down and hits it, or goes up and hits it, goes the opposite direction, and hits your 25-point strike, or your 25 delta option that's now having a delta of roughly 50-ish, give or take. The premise behind your trend is pretty much over. Does that mean that you would be triggered to go the other way automatically? Would that by itself constitute a trend reversal that would warrant speculation of money? You could certainly try that. You know, I developed a parabolic system, credit spreads, where you do that. If you end up losing, by that time you just simply get out and go the other way. Wherever the parabolic shifts, you have a credit spread going on. And as it keeps flip-flopping, you keep flip-flopping your credit spreads. It's kind of interesting. Let's see. Are the DMI Oscillator and DMI Stochastic indicators available only in Metastock? James, you can program those in Thinkorswim, I believe. I do not have the code. However, someone earlier in the class says that they are available. So if you're using TOS's platform, I'm sure there's a place you can go and try and get the code for these things. Of all the credit spread campaigns you have created, which campaign has the best percentage? Great question, Bill. Of all the credit spread systems I've created, the ones with the best winning percentage are those counter trend approaches. The counter trend approaches, not the trend following like this. Rather, when you have a situation, let me go to this screen here, and I don't even know, we'll have to take a look here, but you can kind of see, let me see here. Okay, where you have divergences is one thing you'd want to take a look at. So, you know, the credit spread approaches that I've created, the ones that work out the highest percentage, are when you have a market high and you have a value in an oscillator, whether it's RSI, or you could even use this one perhaps. When price makes a new high, and the oscillator, whether it's RSI, DMI oscillator, or whatever, MACD, we've done it with MACD. When you have a market making a new high and the oscillator failing to make a new high, all right, what you want to think about doing at that point is selling premium way the heck out of the money up here. Because it's very likely, it's very unlikely that the market yet still has enough legs in it to go up another standard deviation and hit that short strike way up there. Now it might, and goodness knows, in the indexes recently, we've seen the market make just outstanding upward one standard deviation extra moves, even after it's already made some strong moves. It just keeps going and going. It's you know, quantitative easing to infinity, you know, QE 1, 2, 3, 4, you know, it just, the market's responding to this. It just keeps going on. And so here you have a typical setup, but nevertheless, when you do the research, when you backtest these things and you sell a standard deviation out when you have divergences going on like this, you are picking tops and bottoms. You're challenging the market to get another set of legs to keep going, and 9 times out of 10 it fails to keep going and hit that short strike that you've just sold way tarnation out there. Okay, but that would be somewhere around the high 80s, low 90s winning percentage. You know, to answer your question there, Bill. Okay. Great. And by the way, those strategies are taught in level 2 of our mentoring curriculum. Level 2 at this point. Okay. Those of you into futures, we have a futures curriculum where we get into them there as well. Folks, we'll be back next week. You'll have another mentor aboard. I think Papali's joining us. Steve Papali will be in to talk about options trading. Same bat time, same bat channel, Monday, 1 o'clock Central. Take care. Have a great rest of the day. Bye-bye.